Hello, a very lovely good evening. So how's everybody and how your studies are going on? So hope that each one of you are really putting up your best foot forward in fact, and really means doing your studies with greater zeal and enthusiasm. So with such hope, we begin today's session. So what we are supposed to do as always is the question which definitely you would like to toss up. So we have decided, in fact, today to actually begin this particular session with redemption of preference shares, in fact. And as far as redemption of preference share is concerned, not a very tough topic. In fact, it is very, very similar to the one which we have already done. It is very, very similar to buyback of shares. Under buyback of share, by now you are well familiar with it. So under buyback of share, as you have already seen actually, that an entity redeems its equity share capital, although we refrain ourselves from using the word redeem. As I told you, even in buyback of share, rather we use the word buyback of share. Because in case of equity share, there is no earlier commitment that company is going to redeem. But as far as preference share is concerned, Section 55 of Companies Act 2013 deals with redemption of preference shares. And as far as redemption of preference share is concerned, any entity who has issued preference share is supposed to redeem it. Of course, within a maximum period of 20 years. In case of companies indulging in infrastructural, what we call activities, and some other entities, in those cases, preference shares can be redeemed within a maximum period of 30 years. Generally, a company is supposed to redeem its preference share within a maximum period of 20 years. But as per Section 55 of Companies Act 2013, even in some cases, preference share may be redeemed within a maximum period of 30 years. Correct? But the point here is that whenever an entity issues preference share, it commits itself that these preference shares are going to be redeemable after some or other point of time, within a maximum period of 20 years or within a maximum period of 30 years. Correct? Now, as we have seen, I have already told you, this chapter has got great similarity with buyback of shares. Under buyback of share, when an entity actually buys back its equity share capital, the capital structure of the company gets altered, and which as a result no entity can afford. So similar is the situation here. So when a company will buy back its preference share, its capital base will get altered, and no company, as you know actually now, that can afford any changes or any alterations in its capital base. So that is the situation here. That means the accounting treatment will run on the similar pattern and similar lines which we followed under buyback of shares. So those situations will arise here and similar accounting treatment will follow. So nothing new to add as far as this particular chapter. So even that, nothing new to add, but we are supposed to do the chapter, so we are going to do it. So redemption of preference shares is the topic for the day. And first of all, in this particular session, what we are going to do, we are going to understand the conceptuality, and then as what we call, we are under a habit of writing the notes later on. Correct? So redemption of preference share. Redemption of preference share. Redemption of preference shares. Redemption of preference share, this is topic for the day. Section 55 of Companies Act of Companies Act 2013. Correct? This chapter will run on similar pattern as we followed in buyback of share. It has already been told to you now. So as far as redemption of preference share, different situations may arise which we have already dealt with under buyback of share. So one by one we are going to take. So first of all, we are going to actually analyze the concept and then we are going to analyze the what we call theoretical notes also, no doubt about that. But at the same time, let me make it absolutely clear, those among you who haven't done buyback of share, my sane advice is that before actually they do redemption of preference share, they must complete buyback of share, then only move over to this particular chapter. So, only difference is that when a company buys back its equity shares, the maximum redemption could be up to 25% as we had seen. But as far as preference shares redemption is concerned, that is generally 100%. So that is the only difference. So we will take up, first of all, the topic is that we will try to understand the conceptuality. So as far as conceptuality is concerned, what we mean by conceptuality? Concept 1. We will try to understand the concept. Concept means entire theme of the chapter. So concept 1. Under this concept, the heading is that when company has sufficient reserves, when entity 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 has sufficient reserves. When I will use the word reserves, unless and until otherwise stated, it means I am referring to revenue nature reserves. I hope you remember that there are 4 types of reserves, basically 3 types. Free reserve, in free reserves are of 2 types, revenue reserves and capital reserves, correct? Which we did under buyback of share. So, now, under the concept of redemption of preference shares, we will try to understand the concept that how, when a company will redeem its preference shares, how the accounting will be done, what methodologies will be adopted, what repercussions it will have. So we will try to understand with the help of this particular example. So example 1. This example deals with when entity has sufficient reserves. Example 1. You consider this chapter as an extension of buyback of shares. Example 1. In this example, balance sheet extract, balance sheet extract, balance sheet extract of P5 is balance sheet extract of P5 Limited is given to you. Given to you 1 shareholders fund, shareholders fund. As far as shareholders funds are concerned, shareholders funds 1, you have been given share capital in this case, and share capital 10%, 5,000 preference shares of rupees 100 each. Correct? So you have got in this case reserves, you have got preference share capital worth rupees 5 lakhs. Now, B, reserves and surplus. Reserves and surplus. Say company has got general reserve to the extent of 3 lakhs. Company has general reserve to the extent of 3 lakh. company has profit and loss account to the extent of 2 lakhs. Correct? This is the extract of the balance sheet of P1 Limited. Correct? We are trying to understand the accounting pattern which we are going to follow under redemption of preference share, even though it has been told to you now on umpteenth occasion that the accounting treatment shall follow similar pattern which we followed under what we call buyback of share. Now, first of all, we are going to pass down the entry, and the entry will be amount due for redemption, similar to the one which we used to pass under buyback of shares. Amount due to preference shareholders. So first of all, you are going to make the entry for the preference shareholders amount due. Amount due to preference shareholders. When you are going to redeem the preference share capital, you will ask the preference shareholders to give back their shares to the entity. You consider yourself as an entity. You are doing the entire accounting from the point of view of the entity. So you are going to receive the preference share, of course, from the preference shareholders, and then you are going to make the amount due. So your entry will be 10% preference share capital account debit, 10% preference share capital account debit. That is 5 lakh. 5,000 share will come back to you. Correct? And then you are going to write to preference shareholder account. Just for your knowledge sake, nowadays preference shareholders are also christened as preference share redemption account. Correct? So rather than writing preference shareholder account, I have got every liberty and freedom to write preference shareholder account or preference share redemption account. One and same thing. So your first entry will be 10% preference share capital account debit to preference shareholder account. After having done this particular entry, now what happens? Our capital base will get altered, as we know. So, and no entity can afford any changes in the capital base. So it becomes imperative, it becomes necessary for us to restore the capital base, isn't it or not? In order to restore the capital base, what we are supposed to do? We are going to do a working, that is restorement of capital base. I hope things might have by now reminded to you, which we did under buyback of share. Absolutely similar pattern and methodology we have to follow in it. So somewhere in the working note I will write here, working for restorement of capital base. Working for restorement of capital base. Why we are supposed to do this working? Because when a company would redeem its preference share capital, as you could see now, our preference share capital will get debited. And if preference share capital will get debited, now what will happen? Our capital base will definitely get altered. No capital, no entity can afford any changes in its capital base because it sends down wrong messages in the capital market. Correct? So no investor would like to invest into our company. Similarly, financial institutions will shy themselves off from investing into hard-earned money, and so on. So such wrong messages will be released in the capital market. So that is the reason actually that no entity can afford any changes in its capital base. So it becomes imperative, it becomes necessary for us to restore the capital base. In order to restore the capital base, we are supposed to do this working. So, working. Now we are going to do this working. Working for restorement of capital base. Working for restorement of capital base. Working for restorement of capital base. So we are going to pass this, we are going to do this working. Purpose is to restore our capital base, means we want our capital base to be at original level. So, for the same, what we are supposed to do, we are going to note down the nominal value of preference share capital to be redeemed. Nominal value value of preference share capital, nominal value of preference share capital to be redeemed. Nominal value of preference share capital to be redeemed. Now, nominal value in this case is rupees 5 lakhs. In order to restore the capital base, as you remember, a company utilizes its free reserves or revenue reserves. Correct? Revenue reserves, or company goes for fresh issue of equity share if there is deficiency of revenue reserves. In order to restore the capital base, an entity generally utilizes its revenue reserves. However, if revenue reserves are not available in sufficient quantity, then definitely we are going to actually go for fresh issue of equity shares. So this is the methodology which we used to adopt under what we call buyback of share. So similar methodology we are going to adopt here. So first of all, I am going to write here a utilization of reserves. Utilization of reserves. Utilization of reserves. Utilization of reserves means utilization of revenue reserves. Utilization of revenue reserves. Now, in the balance sheet, you should be expert by now to distinguish and segregate an item, whether it is of revenue nature or not, from the other ones. So in this case, reserves in the form of general reserve and profit and loss account both fall under the purview of revenue reserves. So you are going to write here general reserve first of all. Amount of general reserve in this case happens to be 3 lakhs. And we have got in this case profit and loss account to the extent of 2 lakhs. Is it clear to you or not? Now, if that is clear to you, what we find actually that in this case we have sufficient amount of revenue reserves and we need not require any fresh issue. Is it clear to you? We need not require any fresh issue because in this case we have got sufficient amount of reserves. So, because we have got sufficient amount of reserves, the company need not require to make a fresh issue of equity share. Try to note down the difference. Under buyback of share, the entity, if it goes for fresh issue, used to go for preference share. Because at that time we used to redeem equity share. Now in this chapter we are supposed to redeem preference share. So fresh issue will be of equity share in case if we would require that. Is it clear? So now after having completed this part of the working, now what we are supposed to do? We are going to now pass down the entry for these parts of the workings. Now the next entry will be second entry, utilization of reserves. Utilization of reserves. Utilization of reserves. Now if we are going to utilize the reserves, what will happen? Reserves will be debited without an iota of doubt, so you are going to write general reserve in this case to the extent of 3 lakhs and profit and loss account to the extent of 2 lakhs. So profit and loss account debited 2 lakhs. Do you remember actually what entry you used to pass under buyback of share? Different reserves account debit to? Yes, absolutely, capital redemption reserve. So that is exactly the methodology here. So different reserves account debit to capital redemption reserve account. CRR account. So 5 lakhs. So when we are going to pass down this entry, what will happen? Our capital base will reach the original level. In other words, it means our capital base will get restored. Correct? So once our capital base will get restored, now because our capital base has got restored, we are in a position to make the actual payment. So now the next and the final entry in this case will be actual payment. Actual payment. So your entry with this case will be preference shareholder account debit. When you are going to make the actual payment, what will happen? Preference shareholder will be debited, your liability will get reduced, and your cash will move out of the entity to bank. So this is the entry you are going to pass. Is it clear to you? This is your concept 1. So in this concept, what we analyze that how a company will redeem its preference share capital if the company has got sufficient amount of reserves. So if company has got sufficient amount of reserves, generally we do not confront any problem. Correct? So this is your first concept. And you must have noticed that accounting methodology is running virtually parallel to buyback of shares. Please note it down so that we can move over to the other part. So if you have noted it down completely, now we have got the chance to move over to the other concept, and it is a little bit easier for me too because you are already well aware of the concept. Now we are moving over to concept 2. What exactly concept 2 is? You are already aware of it. As far as concept 2 is concerned, in this case, I am going to make the slight change actually, that when an entity has insufficient reserve, I am going to write insufficient. So this is your second concept, correct? Now, I will make a slight change in the example. This is example 2 now, and name of the balance sheet, name of the company is P6 now. Shareholders fund, well, we will keep it at 5 lakh, and general reserve 3 lakh, profit and loss account 2 lakh, and then I will also write security premium. Security premium. So in this example, I have added yet another item, 1 lakh to the extent of security premium, correct? And little bit of slight change. Some additional information is also furnished to you in this case. Some additional information is 1. Additional information. On this date, directors decide. On this date, directors, this is example 2, on this date, directors decide to redeem. On this date, director decided to redeem its preference share capital, and for the same A, investments having book value of rupees 5 lakhs were disposed of were disposed of for rupees 4 lakhs. Point number B. The question is that on this date, director decide to redeem its preference share capital and for the same investments were sold out. Reserves were utilized to the maximum extent. Reserves were utilized to the maximum extent. Reserves were utilized to the maximum extent. Maximum, this is maximum extent. Now this is second example, correct? So this example deals with the situation in which the entity will not have the sufficient amount of reserves. Some of you might actually feel a little bit confused in the sense that on the one hand I'm saying that company is not having enough amount of reserves. However, in the balance sheet there are reserves, revenue reserves in the form of general reserve and profit and loss account to the extent of 5 lakh. So it seems for a while that reserves are sufficient. But whether the company has got what we call sufficient amount of reserves or not, that will be decided not on the face of the balance sheet, rather when we will move over to the working part. So how we have to move about in this particular chapter? So first of all, pay attention. As usual, your first entry will be, now we will also try to learn the sequencing of the entry. That is of paramount importance. So first point here is, when you will solve the question, first entry will be, of course, due one. Amount due. This is your first entry. So you will be in a better position and better place to actually pass down the entry without my telling, I'm very sure. So entry will be 10% preference share capital account debit, 5 lakhs to preference shareholder account. Just a moment ago, actually, I also told you that preference shareholders nowadays is also known as preference share redemption account. So somewhere in some books, if you would come across the term preference share redemption, immediately it should strike your mind that it is nothing but your preference shareholder account. So this is your due entry. So you are supposed to actually make a payment of 5 lakh to the preference shareholder, but the problem is that whenever we are going to pass down this particular entry, the capital base of the company will get altered. Because the capital base will get altered, now it becomes our bounded duty to restore it to the original level. So in order to restore it to the original level, we will move over to the working part, and as usual under the working, the first step is to write down and note it down nominal value of the preference share capital, which in this case is also 5 lakh, correct? But the most pertinent and most significant question is that before we start our workings, always go through the question and try to find out whether any information related to sale of asset is there or not. In the last example, which we just did a moment ago, actually, there was no such information with respect to sale of asset. But henceforth, whenever you are going to solve down any particular question, you will have to keep an eye and a very close eye whether any information with respect to sale of asset is available in the question or not. Now, in this question, you could find actually that there is an information related to sale of asset. So before actually you go for the working arena, you need to incorporate the entry for the sale of asset, and only after having incorporated it, you will move over to your working part. Is it clear to you or not? Which means the first entry will deal with the amount due, and the second entry will deal with sale of assets, provided some information is given in the question with respect to that. Correct? So now, in this case, my second entry will be sale of investments. Sale of investments. Sale of investments. This is my second entry. Now, company is having investment worth rupees 5 lakh. It has been sold out for 4 lakh. Obviously, entity has incurred some loss. So you will pass down this entry this way round. Your bank account will be debited, of course. Bank account debit. Entity will receive 4 lakh. And there is a loss to the extent of 1 lakh. 1 lakh will be debited. And 2 investment will flow out of the entity. So 2 investments. So if there will be some information available with respect to sale of assets, it is very significant to take care of the fact that you must incorporate the entry first, and then only you will move over to the accounting working part. Is it clear to you? So, after assuring myself that I have incorporated entry for the sale of asset, now I will move over to the working part. In the working part, I will write the nominal value of preference share capital to be redeemed. This is 5 lakh. Now, I will write A, utilization of revenue reserves. Utilization of revenue reserve, if I will ask you, how much is the balance in general reserve? So within a flick of second, you will deliver the answer that, sir, it is 3 lakh. Absolutely correct. No doubt about that. Now my second question is, what exactly is the balance in profit and loss account? So some of you might be tempted to say 2 lakh, but here you will have to exercise some caution and care. There is balance at this moment to the extent of 1 lakh. Why? Because company incurred a loss of 1 lakh. When we sold out our investment, we incurred a loss of 1 lakh. So balance at this moment with the company with respect to profit and loss account is just about 1 lakh. That is the reason actually why I am stressing upon the fact that you need to incorporate this entry first. Is it clear to you? So that you have got the exact amount of balance. So now we can see it is very important to understand that in case of redemption of preference shares as per section 55 of Companies Act 2013, you can utilize only revenue reserves. Is it clear to you? If you remember, under buyback of equity share, we had the liberty to utilize even security premium, surplus balance of security premium. So there is a slight difference between buyback of equity share and redemption of preference share capital, although accounting methodologies are absolutely same. But in case of redemption of preference share, we have to be a little bit more careful with respect to utilization of security premium. So we are not in a position to utilize security premium in case of redemption of preference share. Is it clear to you? So that is the reason in this question, I can't utilize security premium because it is of capital nature for the purpose of restorement of capital base. You got my point or not? So as far as redemption of preference share is concerned, only revenue nature reserves are allowed by Companies Act 2013. Section 55, of course, as far as restorement of capital base is concerned. So these are revenue reserves, and our revenue reserves in this case are not sufficient. So what we are supposed to do now? It is very simple. So in order to restore equity share capital, if reserves are not sufficient, we are going to go for fresh issue. So we'll make a fresh issue now, but we have to again exercise caution that we can't what we call go for issuance of preference share. We will make a fresh issue of equity shares in case of redemption of preference share. So fresh issue. So fresh issue you will make, and fresh issue will be of equity shares. So 1 lakh worth of equity share you will float down in the market to make up the deficiency. So all in all, we have reached the conclusion that whenever an entity will redeem its preference share capital, its capital base will get altered, capital base will have to be brought down to the original level, And in order to restore the capital base, company will utilize its revenue reserves. And obviously, if revenue reserves are not available in sufficient quantity, then we shall have to actually make up the deficiency by way of issuance of equity share. Is it clear to you? So it is virtually the same pattern, same methodology as we did as far as buyback of equity share was concerned. So after completing our working part, now we will have to incorporate the same by way of entries. So entry number 3 will be utilization of reserves. Utilization of reserves. Utilization of reserves. Utilization of reserves. So whatever reserves you have utilized, you are going to debit them, general reserve account debit to the extent of 3 lakh and profit and loss account of course to the extent of 1 lakh. So various reserves account debit, that is general reserve and profit and loss account, to capital redemption reserve account, CRR account, capital redemption reserve account. Now, in this case, you have made a fresh issue to the extent of 1 lakh. So, your next entry will deal up with this issue. So, point number 4, fresh issue of shares. Fresh issue of equity shares. So as far as fresh issue of equity share is concerned, your entry will be bank account debit to equity share capital account. Simple, very simple. So 1 lakh. Correct? This is the entry. Point number 4. So once you have incorporated the entry with respect to utilization of reserves and fresh issues, so it means that your capital base has been restored to the original level and now you are in a position to make the actual payment. So now you are going to make the actual payment. Your entry will be, first you write the narration. Actual payment, and now you will debit your preference shareholder account and you are going to write to bank. So amount you are supposed to redeem is 5 lakhs. So now your liability in the form of preference shareholder has reduced by rupees 5 lakh. Correct? This was our concept 2. So today in this particular session we have completed 2 concepts. In fact, we started off with redemption of preference share. A quick review actually what we did so far in this particular session. So first of all, I started with the fact that this chapter is absolutely similar to the one which we did under buyback of equity share. Same pattern, same accounting methodologies. So with little bit of variations, hardly what we call noticeable. So as far as accounting methodology pattern is concerned, that will be on similar lines, no doubt. So same things when a company either goes for redemption of equity share or preference share, on both the occasions the capital base gets altered. Time and again it has been told to you now that no entity can afford any changes in its capital base, as it is going to have tremendous amount of consequences which are considered very, very harmful for the functioning of the company. Just to cite the case, no investor would like to invest his money into our company. Similarly, potential investor will shy themselves off from what we call having intentions into our company. Financial institutions are not going to provide us any sort of loan. So these are the repercussions actually which an entity will have to actually face if the capital base will be left what we call as it is. So it becomes imperative to restore it to the original level. In order to restore the capital base to the original level, entity 1 goes for utilization of revenue reserve, and second, if the reserves are not sufficient, then company goes for the fresh issue. Is it clear to you? So these are the two concepts which we covered in this particular session, and we are going to continue with the same one, but as usual in our next class, next time. So till then, it's goodbye, good night, and Shubh Ratri.